Hello, my friends. Today we're diving into some little secrets that your banks or your financial advisors often sweep under the rug and may never tell you. Not knowing these things could end up costing you a lot of money without you even realizing it. If you're intrigued by the title, trust me, this video will not disappoint you. For those friends who we haven't met before, my name is Charlene. As a CFA charter holder, I've spent around a decade in the private wealth management industry in Hong Kong, Singapore, Switzerland, and over the period, I've come to recognize some, let's say, secrets that many of us are often unaware of. Today, I'm going to review the top 3 things that your financial advisors may never tell you when you invest with a financial firm, such as with your bank. Today's video might upset some industry players, but I really want to be transparent and truly help by sharing what I've learned. Let's get started. The first secret that I wanted to share is retrocession fee in banking. You'll probably come across terms like management fee or transaction fee or trading fee when dealing with finance, right? Pretty standard stuff. But have you ever heard of retrocession fee or trailer fees? Sounds a little bit more complicated, right? Let's simplify this. Imagine you walk into a bookstore, bank books, and now bank books has a lot of novels on its shelf, but the bookstore bank books didn't write any of them. Those stories, they're written by various authors, which in this analogy are our asset makers. Every time you pick a novel from the shelf and buy it, bank books, the bookstore gets a little kickback from the author as a thank you for showcasing and selling their book in the store. The kickback, yep, that's our retrocession fee. Now let's apply this to the relationship between banks and asset management firms and you together. Think of banks as the shop selling products made by asset management companies. When a bank sells one of their products, the asset management company says thank you by giving banks a fee called retrocession fee or kickback fee or trailer fee. Different names, same thing, because Wall Street, they love to complicate things and make us confused. And sometimes this fee can make certain products like mutual funds more appealing for banks to sell to you compared to other products like ETFs. Why? Because ETFs are traded on stocks exchanges and banks are not getting trailer fee from the asset management firms. In some parts of the world, like the UK, Netherlands, and Denmark, they already banned the retrocession fee or trailer fee. And the other major countries in Europe, most of them have required the banks to clearly disclose this retrocession fee to investors. Here's the rule. If you're giving or getting any thank you bonus, you've got to be transparent about it. But head over to other regions like Asia. The rules are a little bit more relaxed. Remember, it's always smart to question if your bank advisor seems really keen on a particular fund, especially ones that not shining so bright. Ask yourself, is it genuinely for my benefit or because of the juicy retrocession fee they're getting? Stay informed and stay alert. The next little secret that your bank may not tell you is internal referral incentives. So again, before we deep dive into the whole concept of internal referral incentives, you need to know there are 2 main categories of banks in the industry. 1, universal banks, and 2, pure plays. Universal banks are like the Swiss Army knives of the banking world. They do a bit of everything, from regular banking stuff like wealth management to asset management services, investment banking, and corporate banking. If you don't know what are those business lines, please check my previous video titled Inside Investment Bank, Ex-JPMorgan Reviews Real Work Experience. In that video, I used a whole session to explain what they are. I will also put a link in the description area. Big names like JPMorgan, HSBC, UBS, Credit Suisse, Morgan Stanley, Goldman Sachs, those big names in the market Most of them are universal banks. On the flip side, we've got pure play banks. These are specialists. They focus on just one thing and aim to do it really well. If there's a bank only doing wealth management, that's a pure play. Now you might be wondering, why am I giving you this banking 101? Here's the catch. When you walk into a big universal bank, although most of them claim they're independent and they offer funds from many different companies, you might notice they often have a tendency to recommend their own branded investment funds. It's not always because they believe those are the absolute best in the market. Instead, there's a whole internal game at play. The bank, being a big entity with various business segments, often has incentives where one department benefits when it promotes the other department's funds. So that mutual fund they're urging you to buy, it could be from their own asset management segment, and selling it might just earn them a bonus or help them reach an internal target. I'm not saying that internal products are always inferior. There are so many good outperforming funds in the market, but as an investor, it's important to stay sharp. Always question, is this product genuinely the best fit for me, or is my advisor recommending it because there's an internal reward for them? The next secret that I would like to share is about banks and equities. Have you ever wondered why banks always seem so keen on pushing stocks or equities on you? During market upside, most banks say the momentum will continue, buy more. During market downturn, banks usually say don't panic, buy more, buy on dips. No matter what, buy more. Again, I'm not saying equities or stocks are bad. I'm not saying you need to sell stocks or stop buying stocks. And just to be transparent, for me, myself, a significant part of my investment portfolios are in equities or in stocks, and I don't frequently trade. But still, sometimes banks' bullish view on stocks may be more in line with their own interests rather than yours. Why? Okay, then, what banks could get when you buy more stocks with them? 1. Transaction fees. It's the most basic one. Every time you buy or sell stocks, your bank earns a transaction fee. Unlike other assets, the stock market encourages frequent buying and selling due to its volatile nature. The more active the trading, the more the bank earns. For example, imagine you're an active trader making 10 trades a week. If your bank charges $5 per transaction, they earn $50 just from your activity in a week, or $200 in a month, no matter you earn money or lose money. Now multiply that by thousands of active traders. The numbers are just huge. 2. Financing fees. When investors are bullish, they might want to buy more stocks than what they can afford, leading to margin trading. Banks earn interest from the money they lend for these trades. For example, say you are eager to purchase stocks worth $20,000, but you only have $10,000 on hand. The bank will happily lend you the rest, but at an interest. Over time, this interest can add up, especially if you're not the only one borrowing. 3. Asset under management fees, or AUM fees. When you invest in equities through managed portfolio at a bank, they charge a percentage fee based on the total amount you've invested, known as AUM fees. Usually, banks charge much higher AUM fees for stock portfolios than bond portfolios. The more you invest in stocks, the higher the bank's earnings are. For example, if you have $100,000 invested in a managed fund that focused on equities, and the bank charges 100% AUM fees, they make $1,000 of your investment annually. Again, no matter if you earn money or lose money, they charge this AUM fees as long as you invest through this investment portfolio. There are 3 types of fees to watch out for, like I mentioned: transaction fees, financing fees, and AUM fees. Banks make a lot more money when you invest in stocks instead of keeping your money in cash or bonds. Again, I'm not saying don't buy stocks, but be careful when banks keep pushing you to buy more, no matter what is going on. Okay, my friends, I hope you're not too overwhelmed. Let's have a quick recap. Today, we'll uncover some of the little known secrets that your banks or your financial advisors might be keeping hidden. These are the things they may never tell you, but you deserve to know. To quickly recap what we've discussed, 1, we've talked about the concept of retrocession fees or trailer fees. These are like thank you payment from asset management companies to banks for selling their products. It might influence which products your bank recommends to you. 2, we've shared about the world of internal referral incentives. In universal banks, there's often a behind-the-scenes push to promote their own products for internal reasons, which might not always align with your best interests. 3, and we've questioned why banks seem to favor stocks over other investments. The truth is, there are financial incentives for banks when you trade frequently, engage in margin trading, or invest in managed portfolios that focus on stocks. Remember, being informed is your best defense. Always question and seek to understand the motivations behind the advice that you receive. Thank you for joining me today. If you found this video valuable, don't forget to like, subscribe, and hit that notification bell so you never miss an update. And as always, stay curious and stay in control of your financial future. If you want to know more about the banking world, please check my previous video titled Inside Investment Bank Ex-JPMorgan Reviews Real Work Experience. Until next time, see you soon!